Traders seem to agree, seeing rates on hold throughout next year. But if they do move, a hike now is seen as more likely than another cut. Let's get out to Annetta. She joins us from Frankfurt with more on what to expect. Annetta, there's great expectations now around a hold, but the staff projections around growth, some updates expected there. It feels as though Isabel Schnabel in recent weeks just put the cat amongst the pigeons around the potential for a rate hike down the track.
Yes, exactly. I think that's a fair summary. I mean, if you look at like 2 or 3 months ago, the ECB has moved a lot and the market has moved a lot with it. And now that we're expecting that the next move will actually be a rate hike, it's also a sign of the better than expected performance of the Eurozone economy. So if you look at recent hard data, they have all been positively surprising. And that makes the ECB also now lift their staff forecast most likely. I mean, Christine Lagarde was really bluntly hitting at that. So this is what we are expecting today, higher growth rates in their staff projections for this year, but also for next year. Most likely they won't touch inflation. Inflation is expected to stay below target also during the course of next year, might actually be higher than their target in 2028. But that's because the European the emission trading system 2, the ETS 2, is pushed down or pushed in the future, and that will lift prices for households eventually in 2028. So it's more of a technical factor, but they of course have to take account for it as well in their staff projections. So that's the sort of environment the ECB is operating in, given that there are no other trade restrictions or shocks to the system coming from external factors. And that makes them believe that given that the economy is doing much better, the labor market might actually also do better, then this could push inflation more than previously expected, and that could lead then to a rate hike. But mind you, the Governing Council is divided on the fact whether this is needed or whether we rather should err on the side of caution and look into another rate cut. So I guess this will be a huge topic during the press conference today.
It's fascinating, isn't it? And thank you for setting the scene, Annetta. I do wonder whether one voice has been more amplified than others, and the commentary incredibly important today. Let's get out to Lorenzo Codogno, who is founder and chief economist at Lorenzo Codogno Macro Advisors. Thank you very much for joining us. I mean, the line from your recent commentary is that any residual easing bias is likely to be removed. But again, the point to you, did we hear too much from Isabel Schnabel recently when we're expecting to hear still a neutral line from the governor today, from the president rather, from Christine Lagarde? Has the voice of Schnabel just been amplified when the rest of the members have been very reluctant to give guidance?
I think you're right in a sense that effectively probably the voice of Schnabel has been amplified by media and probably market placed a bit too much attention. However, keep in mind that even President Lagarde at the European Parliament was a little bit on the hawkish side, suggesting that effectively growth has been consistently higher than staff projections. So I think today, as I wrote, I think the message will be that at least a near-term easing bias will be removed. I think it's still far premature to talk about possible hikes. So I think the message will be balanced, broadly speaking.
Yeah, that's a good point, isn't it? I was talking to the Austrian central bank governor in October at the IMF in Washington, D.C., and effectively he was saying to me that the easing cycle is close to an end or at its end, but that's quite different to be talking about a hiking cycle. As you look at the economy, is there any evidence of some resilience here that would warrant a hike down the track?
No, I don't think so. I mean, we have seen a steady and consistent upward revision in GDP projections by the ECB staff. And I think there will be also some kind of smoothing in the say soft patch that was expected in terms of inflation at the beginning of next year, but still no major change over the medium term. So I think the message here is that rates will stay stable for a long while.
One of the big factors for Europe is European competitiveness, and Annette just spelled out some of the changes to the ETS2 system, and it feels as though what previously was a story around climate goals and European competitiveness been entwined is now separating, where the focus really is about competitiveness. How crucial is that? Because a lot of the ECB governors have been talking about the impact of more Chinese goods to arrive in Europe on the back of the tariffs, and that was one of the concerns they had. Do you think that's going to be a feature in the commentary?
Probably not this time. I think, yes, the tariff war is not fully over in my view, so there are still risks on the horizon, but at least now we have a better idea about the kind of landing zone of this debate. And certainly the impact on the Eurozone economy has been very muted so far, in a sense that has textbook would actually suggest tariffs hit the countries that apply them. So I think overall, I think there are a number of factors that in the future will probably be crucial. And one of them certainly tariffs and the trade developments, but there are many others. I mean, let me remind you that today we have a European Council, which is crucially important for the debate about Russian assets and the end of the war in Ukraine. So I think there are many factors that can change the scenario one way or the other, but it's very difficult to translate them into kind of scenarios or even the baseline projections. So I think for now, the ECB is probably better off just focusing on inflation and economic growth.
When it comes to some of the economic forecasts, and we're closely watching that today, a lot of economists were along talking about 2 and 2, 2% inflation, 2% growth, 2% on the deposit rate. Do you think we start straying from the twos from here?
Well, in terms of economic growth, I think we are still far from 2%. So probably this year again will be revised up. Next year, probably starting from a higher base. There will be some upward revision as well, but the long-term outlook will probably stay, broadly speaking, unchanged. Probably the same story for inflation. Inflation is close to 2%. Recently, we have seen some upward tension, especially in services, but they have been affected, or they have been offset by volatile components such as energy and so forth. So, by the way, if energy prices don't change between now and January, probably January there will be a decline in inflation because of a base effect on energy, and that might be as much as 3 percentage points. So there are some near-term variation in inflation, but the medium-term outlook, stripping out the ETS2 effect, I think is still pretty stable.
Lorenzo, we do appreciate your time. Thank you so much for the commentary, getting us set up for the ECB decision today. Lorenzo Codogno with us, founder and chief economist, Lorenzo Codogno Macro Advisors. Now, we're just minutes out from the all-important announcement from the ECB. We will bring you that decision live on the other side of this break. We are now just moments away from the ECB's rate decision. Al Katamol with me, fixed income portfolio manager at Mirabeau Asset Management, to help you out with the numbers. Al, just want to tell us quickly what you're expecting, what you're looking out for.
Well, I think the decision itself is no surprise, and the question is, how are they going to respond to recent market pricing about potential hikes? You know, we're going to watch the path as we go through 2026, and it's just how do they want to manage expectation about their reaction function.
Yep, indeed, a lot of moving factors, I think, internationally for the ECB. It was, of course, tariffs, geopolitics this year, still watching some of those factors. And we were just discussing with Annetta that Isabel Schnabel in recent weeks coming out in a very hawkish manner, but the other members just keeping a fairly quiet tone, I think. So we're looking for that commentary today, aren't we? Yeah,
I think they want to keep optionality open because as we've seen such a volatile year this year, I think we should probably expect a volatile year next year, and forecasts are always look foolish in hindsight.
So the decision just hitting the tape now. No change on the deposit rate, still 2%, and the refi rate still 2.15%. So that is standing pat as it leaves these facilities unchanged. The marginal lending facility unchanged also at 2.4%. So no change on the three main interest rates. The new Eurosystem staff projections show headline inflation averaging 2.1% this year, 1.9% in 2026, 1.8% in 27, and then hitting that 2% level stable by 2028. So we are gliding lower, it seems, on inflation through 26 and 27 before picking up and finding a stable level. ECB saying inflation nexting out energy and food, staff projection on average 2.4% in 25, 2.2% next year, and 1.9% 2027, 2% by 2028. So Xing out some of those anomalies. The inflation number for 2026 revised up mainly because staff now expect services inflation to decline more slowly. ECB is determined to ensure that inflation stabilises at its 2% target in the medium term. ECB saying will follow a data-dependent and meeting-by-meeting approach to determining appropriate monetary policy stance. I don't think we expected anything different on that. Interest rate decisions in particular will be based on its assessment of inflation outlook and risks surrounding it, not pre-committing, and saying on the APP and Pandemic Emergency Purchase Program, of course, we've closely been watching that as well. Portfolios are declining at a measured and predictable pace. The new inflation projections, I think we're going to debate that in just a moment. When it comes to the updated assessment, reconfirms that inflation should stabilise at the 2% target over the medium term. Looking for some new lines here. Inflation revised up for 2026, mainly because staff expect that services inflation to decline more slowly. And I think that is key because all the conversations I've had have been about just how sticky that services side is, even though we've had challenges elsewhere. Economic growth is expected to be stronger than in the September projections, driven especially by domestic demand. So to those new forecasts on growth, 1.4% this year, 1.2% in 2026, 1.4% in 2027, and expected to remain 1.4% in 2028. So that is some of the crucial data we have been watching. Euro dollar is 1.1735, so we're just drifting slightly weaker at this hour. Let's get out to Annetta. Annetta, you're closely eyeing all the detail too as it's hit the tape. What's your view? What jumps out to you?
Well, it is actually exactly what we were expecting, an upgrade to their economic growth perspectives or projections, and also a slight change to the inflationary dynamic, because clearly in recent inflationary prints, we've seen that service price inflation is still running considerably hotter than the ECB would like it to be, especially in big countries like Germany, not so much in France and Italy, but interestingly, again, Spain also has a very similar inflation picture as Germany does. So in parts, it's much higher than, or not much, but higher than the ECB would like it to be, especially when it comes to core inflation. And here the concept of domestic inflation is kicking in once again, and that is service prices and also wage developments, which still are running too hot for the ECB's liking. slowing. That's why we see that upgrade of the inflation expectations for next year. But mind you, it's still below their real target. For 2028, the market would have expected a little bit of a higher inflation projection than we got now from the ECB. That is perhaps a sign that the ECB is not overly panicky about inflationary developments, and perhaps they want to rein in also the market expectation that a hike is around the corner in a way, because the market is getting ahead of itself. But still, the ECB is currently confronted with quite a benign picture. If you look at and compare them to other central banks, the Fed, but also the Bank of Japan, they've managed to bring inflation down to their target with a very rigorous monetary policy stance, but at the same time keeping their independence. So when we look at in the United States, it seems rather that the new 2 or the old 2 is the new 3, and also the Bank of Japan is not very active given the inflationary environment. So again, the ECB might actually tap itself on the back and say, we have reached our target by the policy measures. But of course, it remains to be seen how the next year pans out, especially when it comes to economic growth.
Indeed, and that is the key, isn't it, Annetta? Thank you very much for the assessment. Al Kadamol staying with us, fixed income portfolio manager at Mirabeau Asset Management. What did you make? What's your reaction?
So I think those 2026 numbers are probably slightly hotter than the market would expect, or the consensus was. And if I read that as the way the committee are thinking about the balance of risks, we'd seen a de-risking of that kind of recession risk coming out of the September-October meetings. And we were looking for what is the balance between upside and downside. So by bringing stronger growth, higher inflation in the 2026 number, it makes me feel that the committee think that 26 is a bit stronger, leaning more towards that hawkish edge.
When it comes to some of the calls, and we were just talking to Lorenzo Codogno there about any removal of an easing bias. To me, though, if you still look at the core inflation numbers, you're not that far above target by 2026, 2.2%. Then you slip below the 2% handle, or even lower when it comes to the headline inflation number. How on earth are we talking about hikes when we're pretty much on target?
No, I think that's what a lot of commentators have said in the market. And we saw Lane come out and explain how you could have short-term deviations without having a significant change in policy. What we've had is a change in attitude towards a clear easing path. But I think the bar for raising rates here is still very, very high. You're still below target in the further end projections. Wage growth is still expected to trend down, even though perhaps slightly slower than in the October meeting. So the bias to get higher rates in the next 6 to 9 months is very, very difficult.
My reading on the growth numbers too, it does not look like runaway growth. We're talking about levels that look to be still a growth rate that's required a lot of stimulus to be thrown at the system. Of course, looking to the fiscal position out of Germany to see what that does. But growth revised up 1.4% this year, 1.2% next year. So that is some slippage, 1.4% in 27, 1.4 in 2028. Again, not runaway growth. That can be a fragile story to maintain given the consequences of some of the Trump policy action this year. So is any of this growth even bankable at this point?
No, I think you're very right. European growth has tended to disappoint over the long term. And you've got a lot of assumptions in there to see that speed up into 27, 28. You've still got most of the trade policy to come through. You've still got Chinese dumping going on. You're going to have FX impact. You've got the oil price coming through. You're still very weak. You've got manufacturing PMI still sub 50. So there's a lot of weakness still underlying the European economy. And a lot of weight has been put on the German stimulus. Will that come through on time? Will it deliver in the right places? Will that stimulate growth? And can we get the European consumer to spend? The savings rate is very, very high. Even with wage growth, people are still concerned about price levels. So they're not spending, they're hoarding, they're trying to rebuild wealth. Whereas really you need the European consumer to say things are okay. I believe in these growth projections and we're going to get out there and spend.
The economic growth story that was proving resilient, though, was the domestic demand story. Why do you think that was? Was that just some pent-up demand that's come through? I mean, if you take the situation across in France, obviously there was a big political situation that kept a lot of consumers cautious, and they were banking more savings. And in fact, when I spoke to Valerio de Gallo earlier this year, he thought if some of those savings were deployed, you could just see an economic bounce. I mean, the other factor being Spain too, with the tourism story. So what do you put that domestic demand story down to?
I think we've seen that gradual recovery in confidence from, basically out of COVID, out of Liberation Day. The European cycle is running slightly behind the US. And then as we've seen financial markets come up, people get more confident in their ability to maintain their wealth level, to maintain their job, to maintain their spending. So it's just that general, feeling of well-being. If you remember 23, 24, we were told every week there was going to be a massive recession. So people's spending habits would have changed during that period and not want to put themselves at risk. The same as companies, we don't see that taking on.
Just quickly, the currency, how big a factor? I was talking to one of the central bank governors, I think it was Pierre Wunsch, who was saying they're looking to see whether this is a one-off adjustment, given some of the weakening we've seen in the US dollar. And if it were not a one-off adjustment, it could have consequences. Do you think the currency is going to be a factor for the ECB into 2026?
Yes, I think it's a real one of our risk factors. So, we had the sell US theme earlier in the year. We're going to get questions about the next central bank governor for the US and then credibility of US as a financial system. So if that theme picks up again and we can see another 5-10% weakening of the dollar, then that will have a significant impact, for such an export-based economy. It will keep inflation lower, but reduce external demand for products, and that will continue that pressure on the manufacturing sector, which you really need to see some improvement.
Yeah, juxtaposed against the depreciation of the Chinese currency, making Chinese goods more competitive. Thank you very much for joining me for this decision today. Al Khatama with us, fixed income portfolio manager at Mirabeau Asset Management. Oh, don't miss Christine Lagarde's press conference that is live on the CNBC International Live YouTube page at 1:45 London time. Well, that's it for Decision Time. I'm Karen Cho. We're going to hand you back to our colleagues stateside.
Good afternoon and welcome to our press conference with President Lagarde and Vice President de Guindos. My name is Wolfgang Preußel. We have participants that are online. If they take the floor, please turn on your cameras and your microphones. And with that, I hand over to President Lagarde, please.
Thank you very much, Wolfgang, and good afternoon, good morning to all of you. The Vice President and I are pleased to welcome you to our press conference. The Governing Council today decided to keep the three key ECB interest rates unchanged. Our updated assessment reconfirms that inflation should stabilize at our 2% target in the medium term. The new Eurosystem staff projections show headline inflation averaging 2.1% in 25, 1.9% in 26, 1.8% in 28, 1.8% in 27, and 2% in 28. For inflation excluding energy and food, staff project an average of 2.4% in 25, 2.2% in 26, 1.9% in 27, and 2% in 28. Inflation has been revised up for 2026, mainly because staff now expect services inflation to decline more slowly. Economic growth is expected to be stronger than in the September projections, driven especially by domestic demand. Growth has been revised up to 1.4% in 25, 1.2% in 2026, and 1.4% in 2027, and is expected to remain at 1.4% in 2028. We are determined to ensure that inflation stabilizes at our 2% target in the medium term. We will follow a data-dependent and meeting-by-meeting approach to determining the appropriate monetary policy stance. In particular, our interest rate decisions will be based on our assessment of the inflation outlook and the risks surrounding it, in light of the incoming economic and financial data, as well as the dynamics of underlying inflation and the strength of monetary policy transmission. We are not pre-committing to a particular rate path. The decisions taken today are set out in a press release that is available on our website. I will now outline in more details how we see the economy and inflation developing, and will then explain our assessment of financial monetary conditions. Looking at the economic activity, the economy has been resilient. It grew by 0.3% in the third quarter, mainly reflecting stronger consumption and investment. Exports also increased, with a significant contribution from chemicals. The sectoral composition of growth was dominated by services, especially in the information and communication sector, while activity in industry and construction remained flat. The pattern of services-led growth is likely to continue in the near term. The economy is benefiting from a robust labor market. Unemployment at 6.4% in October is close to its historical low, and employment grew by 0.2% in the third quarter. At the same time, labor demand cooled further, with the job vacancy rate at its lowest level since the pandemic. The staff projections see domestic demand as the main engine of growth in the years ahead. Real incomes are set to rise further, and the saving rate should gradually come down from its still high level, supporting consumption. Business investment and substantial government spending on infrastructure and defense should increasingly underpin the economy. However, the challenging environment for global trade is likely to remain a drag on growth in the euro area this year and next. The Governing Council stresses the urgent need to strengthen the euro area and its economy in the present geopolitical context. We welcome the European Commission's call for governments to prioritize sustainable public finance, strategic investment, and growth-enhancing structural reforms. Unlocking the full potential of the single market is crucial. It is also vital to foster further capital market integration by completing the Savings and Investments Union and the Banking Union to an ambitious timetable, and to rapidly adopt the regulation on the establishment of the digital euro. Looking now at inflation. Annual inflation has been in a narrow range since the spring and remained at 2.1% in November. Energy prices were 0.5% lower than a year ago, after a larger decline in October. Food price inflation was 2.4% after 2.5% in October and 3% in September. Inflation excluding energy and food was steady at 2.4% as goods and services inflation moved in opposite directions. Goods inflation declined to 0.5 in November from 0.6 in October and 0.8 in September. Services inflation rose to 3.4% in October and 3.5% in November from a 3.2% in September. Indicators of underlying inflation have changed little over the recent months and remain consistent with our 2% medium-term target. While growth in unit profits was unchanged in the third quarter, unit labour costs grew at a slightly higher rate than in the second quarter. Compensation per employee rose at an annual rate of 4%. This was more than expected in the September staff projections and was due to payments over and above negotiated wages. Forward-looking indicators such as the ECB wage tracker and surveys on wage expectations suggest that wage growth will ease in the coming quarters before stabilizing somewhat below 3% towards the end of 2026. Inflation should decline in the near term, mostly because past energy price rises will drop out of the annual rates. Staff expects it to stay below 2% on average in 26 and 27, with energy inflation negative over most of this period and inflation excluding energy gradually declining. Inflation should then return to target in 28 amid a strong rise in energy inflation. This, in part, reflects the upward effect on inflation of the EU emissions trading system 2, which is now expected to start in 2028, a year later than assumed in the September staff projections. Inflation excluding energy is projected to stabilize at around 2% in the final years of the projection horizon. Most measures of longer-term inflation expectations continue to stand at around 2%, supporting the stabilization of inflation around our target. Let's look at the risk assessment. While trade tensions have eased, the still volatile international environment could disrupt supply chains, dampen exports, and weigh on consumption and investment. A deterioration in global financial market sentiment could lead to tighter financing conditions, greater risk aversion, and weaker growth. Geopolitical tensions, in particular Russia's unjustified war against Ukraine, remain a major source of uncertainty. By contrast, planned defense and infrastructure spending, together with productivity-enhancing reforms, may drive up growth by more than expected. An improvement in confidence could stimulate private spending. The outlook for inflation continues to be more uncertain than usual on account of the still volatile international environment. Inflation could turn out to be lower if the rise in US tariffs reduces demand for euro area exports, and if countries with overcapacity increase their exports to the euro area. Moreover, a stronger euro could bring inflation down further than expected. An increase in volatility and risk aversion in financial markets could weigh on demand and thereby also lower inflation. By contrast, inflation could turn out to be higher if more fragmented global supply chains pushed up import prices, curtailed the supply of critical raw materials, and added to capacity constraints in the euro area economy. A slower reduction in wage pressures could delay the decline in services inflation. A boost in defense and infrastructure spending could also raise inflation over the medium term. And extreme weather events and the unfolding climate and nature crisis more broadly could drive up food prices by more than expected. Turning now to the financial and monetary conditions. Market rates have increased since our last meeting. Bank lending rates for firms have been broadly stable since the summer, after falling in response to our policy rate cuts over the previous years. In October, they stood at 3.5%, unchanged from September. The cost of issuing market-based debt was 3.4%, also close to its September level. And the average interest rate on new mortgages, again, held steady at 3.3% in October. Bank lending to firms grew by 2.9% on a yearly basis in October, unchanged from September. Corporate bond issuance rose by 3.2%, broadly unchanged as well. Mortgage lending strengthened, growing by 2.8% after 2.6% in September. In line with our monetary policy strategy, the Governing Council thoroughly assessed the links between monetary policy and financial stability. Euro area banks are resilient, supported by strong capital and liquidity ratios, solid asset quality, and robust profitability. But geopolitical uncertainty and the possibility of a sudden repricing in global financial markets pose risks to financial stability in the euro area. Macroprudential policy remains the first line of defense against the buildup of financial vulnerabilities, enhancing resilience and preserving macroprudential space. So in conclusion, the Governing Council today decided to keep the 3 key ECB interest rates unchanged. We are determined to ensure that inflation stabilizes at our 2% target in the medium term. We will follow a data-dependent and meeting-by-meeting approach to determining the appropriate monetary policy stance. Our interest rate decisions will be based on our assessment of the inflation outlook and the risks surrounding it, in light of the incoming economic and financial data, as well as the dynamics of underlying inflation and the strength of monetary policy transmission. We are not pre-committing to a particular rate path. In any case, we stand ready to adjust all of our instruments within our mandate to ensure that inflation stabilizes sustainably at our medium-term target and to preserve the smooth functioning of monetary policy transmission. And we are now ready to take your questions.
And today the first question goes to Balazs Korani of Reuters. Balazs, please.
Good afternoon and thank you. 2 questions, President Lagarde. The first one is about interest rates. And the question is, are we still in a good place? Whenever the interest rate moves next time, is it more likely to go up or down? Do you have clarity on that? Second question is about economic growth. Given your second straight fairly large revision in the growth outlook, is this just simply resilience to uncertainty, or should we be rethinking our entire assessment of the growth profile? Are we catching perhaps a windfall from the AI boom? Are firms more resilient and adapting to the new reality better? Is there some fundamental change about growth, or is it just a one-off improvement?
Well, thank you very much for your two questions. I'll try to unpack because there's a lot there. On interest rate, we reconfirmed that we are in a good place, which does not mean that we are static. There was a unanimous decision that was taken today concerning the rates that we decided to hold, but there was also a unanimous view that all optionalities should remain on the table, and that we would stick to the meeting-by-meeting, data-dependent approach with no rate path set and no set date for any move. And it was a unanimous view around the table. So I think that addresses your first question. Your second question is always an interesting question from you, but it's an interesting question because it raises issues that we will probably review in deeper details at our February projection next exercise, because we will also be looking at the surveillance report that we produce. We will be looking at the fiscal monitor. We might look also at the supply side review to go a bit deeper in some of the facts that would answer your question. We think that there is some change taking place in our economies. And if you look in particular at the drivers and what has surprised us on the upside, it's characteristically investment. And it's not just spending by the public sector, which there is, but it's also the private sector, the corporate sector, both large corporates, but also SMEs as well. And their investment, based on the data that we collect, based on the surveys that we conduct, is largely attributable to the development of AI. And AI takes multifacets, but certainly computer capacity, telecommunication, additional investment in intangible, more than tangible capex is really characteristic of what we are seeing at the moment. So that is something that we can already analyze, but I think we will be able to go a bit deeper in February, as we will see a bit of a longer interval to determine whether that's a long-lasting fact that is characteristic of this new growth. But that is clearly in play. The second one, which came as a bit of a surprise to us, is the contribution of exports. We had anticipated that exports, particularly out of the chemical industry and out of Ireland notably, but not only, would really correspond to a build-up of inventory and to a front-loading in the early months after the decision to increase tariff, or pre-decision to increase tariff. Well, that has been sustainable. And the contribution of exports has surprised us on the upside. So we don't know whether it's entirely attributable to the weight-losing drugs that are largely exported, or to other phenomenon, but the contribution of export has surprised on the upside, when in fact we believe that trade is more likely, as a result of tariffs, to be a drag on growth going forward. So that's also something that we will be attentive to. Thank you.
And the next question goes to Annette Weisbach of CNBC, please. Annette.
Thank you very much. President Lagarde, I have a question as well, going back to Isabel Schnabel's comment on the rate hike. Are you as comfortable with how the market is pricing in the current rate expectation as she is? Second question is on the fiscal stimulus in Germany. We were waiting for that for this year. Now there's hope it comes next year. What is your assessment, what it does as well to other countries in your area when it comes to the growth outlook for the whole? Thank you.
Well, thank you very much for your two questions. You know, certain things have changed and others have not changed. So when we look at activity, we have upgraded our projections. They've moved to the upside across the projection period. When we look at inflation, we've also increased our inflation projection for 26, and we have taken into account the movement from 27 to 28. So there are lots of things that have moved in that respect. One thing that has not changed much at all, and which, if anything, may have actually worsened, is uncertainty. And uncertainty is not a comfortable position. So I think we all suffer from that degree of lack of comfort. And we are all attentive to uncertainty, how it pans out, whether it's uncertainty related to geopolitics, whether it's uncertainty related to the movement of trade from countries with overcapacity in particular, what happens at the borders of Europe. So there are lots of factors that are in play and that will evolve over the course of 26 that are generating uncertainty. And as far as the future is concerned, as I told your colleague just earlier on, there was unanimous agreement around the table about the fact that all optionalities should be on the table and that we should stick to the meeting-by-meeting approach, to the data dependency, and we will be looking at all sorts of data in the field of wages, salaries, the decomposition of it. We will be particularly attentive because it plays a significant role in relation to services. And we do not have a set path for our rates going forward. I know this is, everybody would like some forward guidance, but we simply, in the current situation, with the degree of uncertainty that we are facing, we simply cannot offer forward guidance. Now, your second question related to government spending, public investment, and you know, we take into account the documents that are filed by the various member states with the Commission to review the path of investments going forward. And we have an impact on growth for certain countries, you know, Germany being, you know, obviously one, in 26, in 27, and still a bit in 28. And so much can change in the meantime. But it does have an impact, and it is a driver of growth in the investment section that I was describing earlier.
And the next question goes to Mark Schroers of Bloomberg. Mark, please.
Yes, thanks a lot. The first one, unfortunately, also on rates. The discussion today, was there
That's
any...
what we decided today, so you're right.
That's right. Okay, perfect. Was there any discussion about a cut today or about hikes today, just to have more clarity on the discussions today?
I don't have to wait for your second question. The answer is no.
Okay. The second question is on the revamp of the executive board over the next 2 years.
Revamp, you say?
The revamp, right. Yeah. That also includes your role in 2027. I know it's a long time off, to be honest, but there's already a discussion in Germany whether it's time for a German to become the ECB president. And just wanted to know if you think that would be good after 25 years of the institution, if a national from the largest euro area member states would become the ECB president. And as you already publicly said that Klaas Knot would be a good candidate. What do you think about Isabel Schnabel and Joachim Nagel, who both recently...
Okay, well, let me clarify one thing. I don't have any favorite candidate, and I did not say that Klaas Knot was the good candidate. There are plenty of very good candidates. And Isabel is one of them, but there are plenty of them. And I'm sure that there will be more in the future. Why not? I find it terribly satisfactory, in a way, that so many people want to have my job. It's a great job. And it's one when you feel that you can actually matter and affect the life of people and try to deliver for the European Union and for our currency, the euro. But as to who it is, what nationality, it's not, I'll have nothing to say about that. It will be for the European Council, and the decision will be made outside this beautiful institution. So, whatever they decide. But thank you. You have still a long time to ask all those questions, huh? Phew.
Next question goes to Aude Kersulik of BFM Business.
Thank you. Good afternoon, Mrs. Lagarde. The euro's nominal effective exchange rate is at record levels. I know it's not a part of your mandate, but has this point been discussed by the Governing Council? And second question, still regarding to currency, how do you balance the benefits of a strong euro for import prices, good for your mandate, with the risk of a greater exposure to China, which is an important issue for Europe at the moment? Thank you.
Well, thank you very much for your question. I might give you the answer that you expect, which is that we do not target exchange rate. And we do refer to exchange rate in the risk section of our monetary policy statement, if I recall, when we refer to a possible higher exchange, an appreciation of the euro. So I'll refer you to that section in the risk segment of the monetary policy statement. And obviously it is something that we look at carefully as we look at the way in which currencies are positioned around the world. And obviously the current situation of the renminbi is one that we pay attention to, yes.
Next question goes to Olaf Storbeck of the Financial Times. Olaf, please.
Thanks for taking my questions. I have one question on inflation. The higher inflation in 26 was justified or explained with higher services inflation. It's gone up to 3.5 in whatever it was, November, up for and it was on an upward trajectory in the past few months. How concerned are you about service inflation overall? Could this be kind of turn into a nasty surprise? And my second question again is on ECB succession. One of the sitting members of the executive board has basically showed interest in becoming your successor. What's your reading on the law in terms of, is it possible legally to appoint a sitting member of the executive council as ECB president? Because as far as I understand it, it clearly says terms are non-renewable. And would that be in line with the law and also in line with the spirit of that rule, which I think is intended to kind of prevent governing council members or executive board members to kind of jostle for their next job in their current job? Thanks.
Thank you for your two questions. On your first question, thank you for focusing on inflation on services, because it's clearly one domain that we will be attentive to going forward. So you are right that service inflation has increased. It went from 3.2 in September to 3.4 to 3.5. So there is a trend that we look at carefully. A lot of that is related, based on the staff study, is related to wages. And wages have surprised us to the upside. If we look at compensation per employee, for instance, we are at 4%, which is more than had been anticipated, in particular in the September projections. So with wage having increased more than anticipated and being a strong contributor to most activities of services, not all of them, but most activities of services, it's hardly surprising that services inflation is higher than anticipated and contributing to the current inflation number that we have. It's balanced out by goods, as you will have seen in the monetary policy statement, is they go in opposite directions. Goods go down, services increase, and we anticipate two things in relation to that. Number one, that wages will follow a slightly declining trend going forward, and we have wages slightly below 3% at the end of 26. And that is based on measurements instruments that we have, whether it's the wage tracker, which incorporates all the negotiated, the collective bargaining agreement that are negotiated and which roll out into either 1 or 2 or 3 years, depending on the countries, and under which we cover now 8 countries with quite a large number of employees, workers, or whether it is the surveys and the corporate telephone survey that we conduct asking, corporates, where do you see salaries, where do you see wages, how are the negotiations going? So on the basis of all that, we believe that this compensation per employee should decline in the course of 26. But we are attentive because while we believe that a lot of the catch-up, for instance, has taken place, a lot of the one-off specific payments have occurred, we were surprised between September and December in our projection, and that is reflected in our numbers. So we are humble. We look at as many details and data, and we look at the vacancy, of course, to see what's likely to happen. We look at PMI numbers, but that's where we are, and it's a big contributor to services. And we have, because this is one that we really debated quite a bit and that we looked into, and that staff is working really hard to get to the bottom of it. Services is a big package. You have lots of things in there. You have accommodation, transportation, telecom, IT, financial services. There's a lot in there. And some of those sub-sectors of services are labor intensive, are wage intensive, others less so. So we have to sort of balance out and distribute the wage increases that we expect in between all that. But there is really a solid work done in that respect. So your question is, can a sitting member of the executive board be eligible for another board position or the position of president of the executive board? This matter was looked at in the past. It was looked at when Christian Noyer, the then vice president of the ECB, was possibly considered for presidency. It was looked at for Benoît Cœuré, who was then an executive board member and who was also considered possibly for the replacement of Mario Draghi. I think in both those instances, the determination by the jurists, the lawyers of various corners of Europe was that it was not possible. But I think the matter needs to be looked at again in order to ascertain, what is possible, what is not possible, what are the conditions. And it's not for me to pass a judgment on that. I think it needs to be cleared so that everyone knows where to stand.
The next question goes to Isabella Bufacchi of Il Sole 24 Ore. Isabella, please.
Thank you for the opportunity. President Lagarde, I have 2 questions on financial stability, as it was also mentioned on the statement. So financial stability and the international role of the euro could be threatened by the reparations law for Ukraine using the cash balance of Russia's asset. However, so far, the euro has been quite resilient in spite of Putin's retaliation threats. So what is your assessment of this kind of resilience of the euro so far in this respect? and also on financial stability and the digital euro project, which is making progress. The council orientation these days is a milestone, and the digital euro is viewed more and more as an anchor to strengthen financial stability in the euro area. So, in your opinion, could the ECB become a role model in the world to assess the importance of central bank digital currencies? Thank you.
I think I'll start with your second question. I know these are important moments for the digital euro because we have done our work, we have carried the water, but it's now for the European Council and certainly later on for the European Parliament to identify whether the Commission proposal is satisfactory, how it can be transformed into a piece of legislation or amended. Our ambition is not to be role models. Our ambition is to make sure that in the digital age, there is a currency that is the anchor of stability for the financial system. For the moment, that anchor is central bank money, which essentially has material form. It's the banknotes that you have in your wallet. But in the digital age, it has to be a digital expression of that sovereignty and a digital anchor for the purpose of the financial system that we have. So that's what we're pursuing, in addition to making sure that it is user-friendly, not costly, fast, efficient, private, that it can work online, offline. I mean, I could go on and on because you know that I follow that very carefully with my Italian colleagues, and both Luis and myself are very strong supporters of this initiative, and we place great hopes in the work that will be done in Parliament once the Council has made its view, has determined its views. You know, on the other topic that you raised, I'm not going to expand on this matter because it's something that is under review, that is under work at the moment, which is of the competence of the European leaders and which is the expression of foreign policy. So it's not for a central bank to have either political views or central bank's choice as to what is appropriate or not appropriate. Our job, and we are trying to do it as much and as well as we can at the odd hours of the day or the weekend, is to make two choices made by the leaders, is going to respect the treaty, is going to respect the international rule of law, and will not damage financial stability. This is the remit of what is our duty. Beyond that, it's something that is outside our remit. Thank you.
And now Jan Malin of Plato. Jan, please.
Thank you for the opportunity. Madame Lagarde, I have a follow-up question on your first comment about the changing growth profile and due to AI. Isabel Schnabel made a similar comment in her interview with Bloomberg, where she said that the natural interest rate might rise because of that. Do you agree with that assessment? And my second question is on stablecoins. They have gained significant importance globally, but many experts see this as a threat to Europe's monetary sovereignty and are calling for stronger support for stablecoins in Europe as well. What's your position on that? Thank you.
Sorry, I just want to clarify your second question. You don't say that the digital euro is a threat to sovereignty. You said stable coins, right?
Stable coins,
okay,
yeah.
Okay,
yeah.
I had misunderstood.
Oh, okay, sorry.
Yeah, no.
Thank you.
My mistake. So, we are lucky in Europe to have something that is called MiCAR. So it's the legal framework within which instruments like stablecoins can work and can be supervised and can be regarded as safe. So our view is that an instrument that is in compliance with MiCAR is an alternative form of payment, which might have its benefit, might have a business case for those that issue the stable coins. My concern, because I have a concern, so that's, to the extent that it conforms to MiCAR, that it is properly organized, that it has the right one-to-one guarantee for the users, I don't need to have a view. Supervisors need to have a view. Those who control that there is actually the reserve. Where I have a concern is when you have something that is getting a bit technical now, if we go there, is the situation of multi-issuance currency for stable coins. Because without going into the details of how it is structured, it exposes the reserves, the resolution mechanisms, and the redemption mechanism in Europe, as is organized under MiCAR, to other currencies under which the stablecoin would be issued, and which could be a threat and a drain on the provisions of MiCAR that apply in Europe. So on that particular area, I think that we need to be extremely attentive to what the potential risks are for the system itself and for the holders of stable coins. On your first question, look, I'm not going to agonize over the issue of, where and how is the R star and the rate which is ideal because it neither stimulates nor restricts our economies. There are multiple factors that can affect it. Productivity is obviously one of them. If we draw a lot of productivity out of artificial intelligence, it will impact. But there are multiple other factors as well that will impact R star. And one of the characteristics of R star is that you can only sort of identify it eventually in completely stable circumstances. I don't think that we can call the current circumstances as perfectly stable and predictable. There is, as I said earlier, too much uncertainty, too much risks, and too many shocks under the spell of which we still are to actually identify R star and have a view as to whether it's going to increase. So, as I said, it's not observable, so to speak, and I think it's a very good debate to have, but I'm not sure that this is the one that has caught the attention of the Governing Council. It's certainly not one that we debated today, or yesterday for that matter.
And the last question goes to Philippe Lacour of AFP. Jean-Philippe.
Thank you, Wolfgang. Bonjour, Madame la Présidente.
Bonjour, Monsieur Lacour.
Switch in English, of course. I have two questions on the same issue, if I may. It's related to Ukraine. You know that in these hours, the 27 head of states meet in Brussels with a bold agenda. And one of the points is to try to agree on this reparation plan for Ukraine. So single question is, are you confident that they will succeed to find a solution? And the second one is, earlier this month, yes, ECB said we cannot provide a backstop for, to use the frozen Russian assets to finance Ukraine. Simple reason, it would likely breach the treaty, prohibiting monetary financing is the other point. But in these several times, shouldn't the overriding interest of the people of Ukraine to have the right to rebuild their country and live in peace not come above all kind of purely factual legal considerations? And as you said before, for the case of Mrs. Schnabel, would it be possible to maybe look at again, if the question is again raised? Because, I mean, there is overriding interests of the people of Ukraine that may be, above the pure legal considerations. So I would like to have your point on this.
Well, thank you for your question. Your first question, there is work going on at the moment. Again, it's not our remit, it's for the leaders to decide. And given the importance of the matter, given what is at stake, I am fully confident that they will find a solution. It might be in the usual European way, you know, going in circles and being time-consuming and giving rise to a lot of speculation as to whether it will work, it will not work, there will be one camp or the other. But I'm confident that they will find a solution because it's too important. You know, we are an area of the world which praise itself for respecting the rule of law. And this is one of the characteristics of our democracy. The leaders will decide, okay? And I'm sure that there are solutions that can be debated and discussed, and there are constructions that can be elaborated. But it is not for the central bank to actually encourage or support a mechanism under which we would be called upon and scheduled to breach Article 123 of the treaty. This is, you know, monetary financing is not allowed under the treaty. You cannot expect me to validate ex ante a mechanism under which there would be monetary financing. This is pretty obvious. Thank you. And if there is no more questions, then I'm happy to wish you all a Merry Christmas, happy holidays, whatever is convenient, to those of you who celebrate or don't celebrate. And we look forward to seeing you in the new year, bright and ready and still determined to deliver on our mandate and get to our target. And I'm sure you've got other plans than me.
The next meeting is on the 5th of February, by the way, the next press conference.